The 30-year fixed rate just hit a 7-week low, and this is not the rate environment that you think it is. And I'm going to take the next 5 minutes and explain to you why that is. And then I'm going to give you an investor action plan that a smart buyer right now is already using or it will start using. As of the July 2nd Freddie Mac primary mortgage market survey, the 30-year fixed rate mortgage averaged 6.43%. Now that's down 4 bips from the June 22nd baseline of 6.47%. The 15-year fixed average is sitting at 5.79%. Now the daily news, the mortgage news daily range has been running about 6.45 to about 6.5%. And all of these readings are current lender indications as of the report date, not a forward commitment. So here's what is driving it. And it's not the Federal Reserve. The Fed's dot plot from the June 17th Federal Open Market Committee meeting still projects a 3.8% median rate for the year end, implying one more hike. Now, the probability of a July hike fell from 37.6% to about 24.4% after the June jobs report miss, but year-end hike probability remains elevated. So rates are falling because the West Texas Intermediate crude oil is now sitting at $68 to $69 a barrel. That is down 29% from the pre-ceasefire peak. Now, that collapse in oil prices is putting Energy Consumer Price Index lower, and the Cleveland Federal Reserve nowcast is tracking June Consumer Price Index at approximately 3.8 to about 4%. The June Consumer Price Index prints only it prints on July 14th at about 8:30 Eastern Time. Here is what most investors miss about this rate environment. A 7-week low headlines sound like a green light, but here's why that matters only if you understand the risk. The July 14th Consumer Price Index print is a binary event. If June Consumer Price Index comes in below 4% with a soft core reading, then the September Federal Open Market Committee hike probability collapses, and debt service coverage ratio rates could test 6.5, if not lower. If a failed Iran nuclear deal pushes oil back above $85 a barrel, the October rate hike, that's going to be locked in. And then debt service coverage ratio loans, our pricing moves back up to the 6.75. Now, you are not planning for the low. You're planning for the range. That's how it always should be. Now, before I put in the action plan, if you're getting any value out of this breakdown, hit that subscribe button, hit that follow button. And, I post rate updates every single week so that you have data, not options, not opinions. You have firm data driving your deal decisions. So follow on Facebook and on LinkedIn too. But all right, let's jump into that action plan. For DSCR loans as of the report date, the best execution borrowers, meaning individuals with 780 credit, 1.25 or better coverage, you're looking at a 65, maybe 70% loan to value in certain circumstances. You're seeing right now 5.8 to about 6.12. Now, standard borrowers, individuals in that 740 range, looking at 75% LTV, you're more in the range of about 6.12 to about 6.5%. Now, mid-tier sitting at that 700 credit with a 1 to maybe a 1.25 coverage, so you're breaking below that 1.25. 75% to about 80% loan to value. You're looking about 6.5 to about 7.5%, right? So it's a bigger range. But the working underwriting assumption through Q4 as of 2026, Q4 of 2026 is going to be about 6.25 to about 6.75. So for short-term rental DSCR properties in Coeur, Post Falls, the rate is you're going to be about 7 to 9%. Now, Idaho House Bill 583 went live on July 1st, which protects those with short-term rental operations from municipal bans going forward. So that's great. But there's always more to come, right? What's the rates going to do? Here is what a smart investor is doing this week. One, if you have a deal under contract with a rate lock expiration in the next 60 days, talk to your lender right now about that extension cost given the binary July 14th event. Now, two, if you're building toward a DSCR acquisition in Spokane Valley or Kootenai County corridor, run your coverage ratios at both 6.25 to about 6.75 at the bracket for the Q4 range. Now, three, if you are a short-term rental investor in Idaho, July 1st changed your operating landscape. So run your air DNAs or your air RIs so that you can get those comps now to qualify the coverage ratio before the rates shift again. Monday, I am back with the full economic indicators. I'm going into a deep dive on it. I'm hitting stagflation setup, what the jobs report actually means for your portfolio, and the scenario analyst that matters most for the second half of the 2026. If you have any actual loan scenarios that you want numbers on, deep dives on, deal structures for, behind all of these, book a call with me at openlanefunding.com, or the link is below. You can also give me a call at 208-215-9936. I'll see everybody on Monday. Thank you.